Thank you, people, for joining us. We'll wait a few minutes for people to join and come on in. My name is Michael Thompson. I'm a partner and the senior wealth advisor here at Copperleaf Financial in Vermont. And our topic today is ETFs, or exchange traded funds. And I'm very happy to welcome our guest, Anthony Caruso. Anthony is with Dimensional Fund Advisors and heads up works on the investment solutions group as an investment strategist. Anthony spent earlier in his career, he was a vice president at JP Morgan in New York, and is a CFA charter holder and has a bachelor's degree in finance from the University of Dayton. Anthony has an amazing expertise around this topic of exchange traded funds, so I'm really looking forward to our topic today. Couple of housekeeping items. By the way, thank you everybody for joining us. We do encourage questions, so please, we will set aside some time at the end to make sure that there's time for questions, but if you have questions along the way, please feel free to enter them in the chat or in the Q&A at the bottom of your screen, and we'll take them as we come. Anthony, thank you for joining us. You're in Charlotte today, is that right?
That is right, and thanks for having me. Look forward to being here.
You're welcome. We're super glad that you're here. By the way, are you participating in this daily Wordle thing? Have you become a Wordle person?
I have not yet.
I have, and this morning it took me 5 tries to get my Wordle, but I did get it. I wasted my second try, so I probably could have done it in 4, but I tried to get cute before I finished my first cup of coffee. Anyway, welcome to our town hall today. So first, let's start it off. Exchange traded funds, or ETFs, have been really in the news everywhere. I see it more and more over the last couple of years. Let's start off by what is exactly an ETF, or an exchange traded funds, and how does it compare with a mutual fund or an individual stock portfolio? So let's start with the basics. Give us the basics.
Yeah, so when I think about an ETF, and you're right, exchange traded fund is what that stands for. You can think about the name. It's a fund that trades on the exchange. So I like to think about it, though, from the characteristics of how is it similar to a mutual fund and an individual security. So from an individual stock, as in an example, like a Microsoft, when you go to buy a Microsoft, you go to the exchange and you buy it, whether it's through a custodian, your brokerage, your financial advisor, and you can buy it throughout the day on the marketplace. An ETF is the same thing from a stance of you go and you buy it from the exchange. Now, when you think about from a mutual fund side, on the other hand, a mutual fund can have a group of securities within it. So you can have a bunch of different stocks within it. It's broadly diversified, and it's a commingled vehicle such that a bunch of different investors can actually go in and invest in that solution. So an ETF is very similar from that stance, that it's a pooled vehicle. And in the case of Dimensional, building broadly diversified strategies across both mutual funds and ETFs. So those are some of the similarities in terms of those characteristics. And then, of course, there's some benefits to why some investors and why you're seeing it in the news around the usage around ETFs.
Mm-hmm. So hold on, before we get into the benefits, I just want to clarify a little bit. So a mutual fund, I think many of our clients and folks out there are maybe familiar with mutual funds, although I think there's some confusion around that too. But a mutual fund and an exchange traded fund, they both tend to be baskets of individual stocks or baskets of individual securities, right? So like in a mutual fund where I may have 100 or 1,000 different stocks in that basket, the same thing is going to be true with an exchange traded fund. And doesn't the difference have a little bit to do with kind of how we can purchase them? The way I understand it, and we include both mutual funds and ETFs in our portfolios, we can buy an ETF throughout the day. We can kind of pick the price that we're gonna buy it for. It's priced throughout the day, whereas the mutual fund, the accounting is done and it's priced at the end of the day, and we can only buy it at the end of the day no matter what the price is. So we have a little bit more control in that way. Is that one distinction that you would think is important?
That's exactly right. So an ETF, you can buy it on market throughout the day and you can kind of see where it's trading at. A mutual fund, you're right, you buy it at the end of the day. So it's definitely a distinction.
Okay, so let's talk a little bit about some of the benefits. So if I've got a basket of stock in a mutual fund and a mirror image that's a basket of the same stocks in an ETF, because I could have that, right? It could look very similar in content. What are the benefits? Why would I maybe choose an ETF over the mutual fund option? Why might I go that route?
Yeah, and so, with Dimensional, we want to build solutions that can be accessed in a mutual fund and an ETF, and even a separately managed account that can be customized, of course, for clients. But when you think about an ETF, generally, I tend to think that our clients enjoy two benefits from it. First and foremost is when you transact, there's normally a fee or commission you have to trade for certain type of vehicles, or maybe even an individual stock. When you buy an ETF, oftentimes we find for our clients and investors, they can buy it through no transaction fee. And so they're not paying a commission on that. And that's a benefit, right? Nobody enjoys paying commissions. And so some vehicles and some individual stocks, you do have to pay a commission. So that's the first thing. The second thing is around taxes. So when you think about an ETF, there is an additional lever that the vehicle provides such that it can look to defer some of the capital gains by taking some of the securities out of the portfolio and not having to sell them down. And so there's this additional tax lever with ETFs that if you look generally, ETFs as a vehicle can be tax efficient in the industry. It's not to say they will never pay taxes. It's just they generally can be tax efficient by having that additional lever.
Yeah. And I'm so glad you hit on those things, because those are two of the primary reasons why we really like, for our clients, using ETFs in place of mutual funds where we can. And more we've been doing that for a couple of reasons, those reasons. Now, while we don't charge a commission and our custodians don't charge a commission, sometimes they'll charge a trading fee. So if our clients have their accounts at Fidelity or Charles Schwab or TD, for example, those custodians for the dimensional funds or some others may charge $9 or even up to $20 just to trade that mutual fund. Whereas we completely eliminate that cost for the client by using the exchange traded fund or the ETF. So we really like that for our clients. So I'm glad you brought that up. And that tax efficiency, boy, that's a big one, because we know in the past we've seen clients, especially for older, some legacy mutual funds that they may hold, where they're very active and they're generating capital gains within the mutual fund. They'll pass those along to clients, and that can be a nasty tax day. But exchange traded funds avoid that. So we really avoid a lot of that that sort of phantom capital gain within the exchange traded fund. Those are some of the tax savings that we see. Am I on target there?
Yeah. So generally for mutual funds, and I think it's kind of a double-edged sword in terms of you want the mutual fund to appreciate, but because it has to sell securities at a certain point, maybe the style or the investment philosophy around a specific security changed. You may sell that security and incur a gain, and that, to your point, does have to get paid out of the portfolio. I think Dimensional, our strategies across vehicles tend to be tax efficient by design.
Yeah.
But
right.
Within an ETF vehicle, you do have that additional lever. So it's not that they'll never pay capital gains. So great example, let's just take, looking at the end of 2020, we don't have the data yet for the end of this year, but at the end of the 2020, and if you back up 10 years, so that 10-year period, how many US equity strategies, ETFs, and mutual funds paid capital gains? So on the ETF side, it was 7% of the strategies. And on the mutual fund side, it was about 70.5%.
Wow.
And
That's
so,
huge.
so it is a large dispersion. That's just one specific category and one data point in one time period. So not trying to draw too many conclusions, but point being, you have an additional lever that you can use should you have redemptions or clients selling the strategy. That's really when you get some of that benefit. that you can kick out or defer some of those capital gains, but it's not that it'll never pay out capital gains because every ETF can. It just, you have to have a certain requirement of those outflows that you can use to your advantage to defer some of those capital gains for your clients.
Yeah. And we can also use within the portfolio, do some tax loss harvesting and use ETFs in other ways that can lead to more tax efficiency as well. I want to focus on another question, which is sort of the history of ETFs and why have they become popular? I have a feeling that we've answered that with some of the benefits that we just talked about, but I know mutual funds have been around since when the 30s. When was the first mutual fund launched? It goes back to the Securities Act. They've been around for that long. They've gained popularity certainly in the 70s. But run through maybe a little bit of the history of ETFs. How long have ETFs been around, and why have they become more popular in recent times, do you think?
Yeah, so the first equity ETF was in the early 90s. And then the first fixed income was in the early 2000s. So you did have a bit of a delay there to have the first fixed income strategies launch. But I think you're right. It's part of the benefits that we talked about of no transaction fees, of the tax efficiency, being able to trade it throughout the day. Some of these benefits investors may have a preference for. And, so that's why it's, important to have multiple vehicles to meet different investor preferences. But in addition to that, if you look at, mutual funds and traditional active management, some performance has been futile. And so in a movement towards a traditional passive strategies, which you are seeing across the industry, the ETF vehicle had a lot of those launch over the past, 20, 30 years where investors could access it. And so you're seeing some of that movement. I think where Dimensional comes into play of being pioneers in the space that we operate in, of using financial science to systematically and position our portfolios towards those segments that we believe can reward us or have a higher expected return over the long term, we think is a superior approach. And so I think some of that transition is based off the evolution you're seeing. And then more recently, even over just the past 10 years, it's amazing from an education, from a product development and a regulation, what's going on within the industry. And really, when we launched our business in 2020, part of it was because of the regulation change that came out in 2019 with ETFs that allowed us to implement that same approach we've been managing for 40 years in the ETF wrapper. And so you're continuing to now see actually some of those traditional active strategies come to the ETF marketplace. And so, it is now really we're entering a world where if we fast forward 10 years from now, we're probably going to be in a place where you can access different strategies and different vehicles, which again, I think it just makes it better for you all to be able to select the choice that's best for your clients.
Yeah, that's great. And we really haven't talked about the cost differences either, but, mutual fund costs, they started off quite expensive in terms of the underlying expenses, expense ratios, and things like that. Those certainly have come down over time. But I think there's a general idea that ETFs are less costly in terms of expense ratios than mutual funds in general. I think, do you think that's an overall a statement that's generally true?
I think it's partly because the types of strategies that have been ETFs have been some of those traditional passive that are really moving towards zero, and some are already actually, at that mark there. But the second thing I'd say is it's also the expenses that make up to manage a 40 Act strategy. There are two that an ETF doesn't necessarily have. One is a 12B1 share servicing fee. I'm not going to go into details around necessarily what that is. It's not something Dimensional has. But that is a fee that mutual funds can have. And so an ETF doesn't have that fee. The second is a transfer agent fee, which think about from a record keeping of all the holders of those mutual funds. Because an ETF trades on the exchange, it doesn't have that fee either. Now, that fee could be different across different providers. But in general, the way that we approach ETF marketplaces, for a similar strategy, similar approach, similar level of tilt towards those areas where we think we can have a higher expected return, we want to price them similar from a management standpoint. And so that's what we look to do. But you're right. I think when we, you paint the ETF industry with the brush, I think generally many investors see it as, a cheaper option. I think that narrative's continuing to evolve though.
Yeah. We have a question from the audience. Thank you. And the question is, besides tax and cost benefits, are there any significant risk differences between mutual funds and ETFs? What do you think about that, Anthony?
Yeah, so the main considerations for ETFs and what we hear from investors is it's transacting in it. So you actually have to go on the market and buy it versus in a mutual fund, as Michael alluded to, you get the end of day NAV. For an ETF, you actually have to go in and place an order. Your advisor goes in, places an order to transact in the market. Well, you want to make sure you're getting good execution. So what we do is we have a capital markets desk. They follow and monitor our ETFs each and every second to ensure that we're seeing, what would be appropriate and what we would expect. And we engage with financial advisors to ensure that they understand the best practices around trading ETFs. And so that's really what we do. In terms of if it's a risk, it's just you want to follow best practices, just like you would if you're buying an individual security. There's some of those where you may not want to transact in the beginning of the day because the market's still opening up and it's still pricing some of those securities. So some of those are not necessarily just an ETF concept. It's more buying any type of vehicle or individual security on an exchange.
So some trading differences, but in terms of the construction of the underlying portfolio, there's really no difference from a risk profile standpoint, because especially if we're looking at comparable products, and I'll use our approach for example. We use an asset allocation approach. We use, we call our process evidence-based. So we're really filling asset classes. If we're filling a small value asset class, the small value asset class with a mutual fund, we may have an equivalent ETF. The risk profile is going to be very similar in those underlying vehicles. The only difference may be that trading within the day, but that's something that we manage with the desk and manage internally. So a good question. I hope we answered that sufficiently. Let's move on a little bit and talk about first of all, anything that you see in terms of how ETFs have evolved in recent years. And then I want to get into a little bit about Dimensional's approach and why did Dimensional decide to get into this space. But first of all, let's start with what have you seen in terms of changes and sort of the evolution of ETFs over the last 10 years, maybe, because they really truly haven't been around that long.
Yeah, so backing up 10 years ago and thinking about what was the industry focused on, it was education, it was regulation, and it was product development. And at that time, I think 10 years is actually a great data point. So, at Dimensional, you never want to cherry pick. You want robust data. But 10 years ago was a pivotal point for the ETF industry. And part of it's because the ETF assets crossed $1 trillion. And at that same point, there was 1,000 ETFs. And we'll talk about what that is today and how it's continued to grow over that time period. But the focus was education, is and always will be. Like that last question around trading, how to think through some of that, the different types of strategies that were coming out to ETFs. I think you back up 15 years ago, ETF was synonymous with a passive index tracking strategy. So for an example, a strategy that tracks the S&P 500 index, and its investment objective is each and every day as portfolio manager, my job is to track that index, and that's what I'm getting held to. That's what a lot of the industry was, and that's continuing to evolve into some education. The second, on the product development side, is really what you saw over that next 10 years was these types of factor-based strategies. So strategies that are leaning into things like value, or those stocks that have a lower relative price compared to others. And so that was changing from those types of strategies. And then more recently, I would say it's been regulation. So in 2019, there was a huge change to ETF regulation that I think really opened up the door, leveled the playing field in the industry in terms of allowing investors to have a more flexible approach in the way that they operate their ETF. So we can get to why Dimensional entered. One of the reasons of that, of course, behind clients is that flexibility. So to your point, Michael, if you're having two baskets of securities, you can have the same basket if you would like in a mutual fund and in an ETF. And that flexibility is really important. And so from a regulation standpoint, allowing some of that flexibility that now you're starting to see a lot of more even active approaches come to the ETF landscape. So, maybe fast forwarding to, where we are today, we talked about $1 trillion crossed in AUM 10 years ago, 1,000 ETFs. And at that point, there was roughly around, don't quote me on this necessarily, but roughly around, call it 40 providers. You fast forward to today, we're well over 200 issuers or, ETF providers in the marketplace, about 7 trillion in assets. Wow. And depending on the source you use, there's roughly 2,800 ETFs in the marketplace. And so it's been just tremendous growth in the industry. And part of it's because of those benefits, part of it because investor preferences, demands. But it's an exciting time to be a part of the ETF industry for sure.
Yeah. So Dimensional has been around for 40 years, working with advisors like us that are really committed to the philosophy and the investment strategy. And Dimensional has grown tremendously over the last 40 years. So Dimensional's been around. You're not kind of a wet behind the ears, just kind of fly by night organization. But so I think you may have answered this question, but I'm going to ask it anyway. Why change? Why move from a 40-year history and what 400 or 500 billion? I don't even know what the number is, and assets under management. Why branch out? Why get into the ETF space when you did?
Yeah, and so today we're actually about 650 billion in assets. So you're right, there has been tremendous amount of growth, and really it all goes back to clients. We talked about some of the benefits. We've heard that from our clients, and that they wanted to be able to access that same Dimensional they know and love with 40 years, one investment philosophy in different vehicles, and one of them being an ETF vehicle. And so, comes back to clients. Now, the real question I think is, why didn't we launch this before? And the reason for that is because we weren't willing to sacrifice our approach. Because at the end of the day, there may be a preference there, but if we can't deliver our 40 years of experience and implementation and managing strategies in an ETF wrapper, then that's not something we're going to do, because we don't think that's a superior product as we have in a mutual fund. With that ETF regulation change, so the client demand plus that ETF regulation change in 2019, that allowed us to implement that same approach, leveraging 40 years with one investment philosophy in that vehicle to be able to meet the demand that we're hearing from clients and to be able to access those benefits. So I think, to your point, where we are today from Dimensional, we're offering that Dimensional type disciplined approach, one investment philosophy, focus on flexibility across mutual funds, ETFs, and even through custom SMAs. And so providing clients with different choice and advisors so that you can provide your clients with whatever vehicle or approach is best to meet their needs.
And it's certainly true. I'm glad you brought it up. It's certainly true that we've been asking for it. I've been asking for Dimensional to get into ETFs, but wasn't aware of that regulation change. Without getting too much into the weeds, is it possible to sort of simply describe what was the change in the regulatory environment that made it favorable, that made it acceptable, to the Dimensional felt like you could meet your standards and also offer the ETF product? What was that change?
Yes, there's three main components to the ETF role. If you want to read about it, 6C11, I happen to be an ETF nerd, so I've read it a few times, but feel free. A nice Sunday coffee and reading that. So the ETF role, the first and foremost, is that it level the playing field in terms of what types of disclosure you're going to have on a provider website. So if you go to our website versus a competitor website and you look up the ETFs, you're going to see similar level of characteristics in terms of not exposures, but more so from a trading and market quality. What is the bid-ask spreads? What is the premiums and discounts? And just being able to level set compare across strategy. So that was the first thing. The second thing on disclosure was daily holdings available. And that historically, if you think of a traditional active manager or stock picker, that historically may have been a barrier to entry where they don't necessarily want to have their holdings show every day because that's their secret sauce. And so that is something with their role that you have to have a daily holdings. For Dimensional, we're comfortable with that. If you look at some of our portfolios, 2,500 securities, they're broadly diversified. We're comfortable, taking that on. So that's a second. The third piece, and this is really what allowed us to launch, is it's called custom baskets. And I'll try to describe it simply, but it allows us to have flexibility. If you think about how ETFs operated in general, like a passive strategy before this rule. You're going into a rebalance period. The Russell 1000 or S&P 500 is going to rebalance its securities. You are going to buy the securities pro rata. So let's say you have $10 million flow into your strategy. If Apple's 5%, you buy 5% Apple. If Microsoft's 4.9%, you buy 4.9%. Yes.
Hold on a second. I'm going to stop you because this is a really, really important point about indexes, and what you're talking about. You described as rebalancing, but that's really what's called reconstitution, isn't it? So every year, an index, the S&P 500, for example, announces ahead of time a change in the lineup. What's that list of companies that are in the index, right? And if it's an index fund or an index ETF, they have to, their mandate is to mirror that index. They've got to replicate that index as closely to identically as possible. So S&P or whoever the index is, they announce ahead of time what the changes are going to be in the portfolio, right? So there's a reconstitution date at which all the indexes have to change, and all the indexes have to suddenly flip and represent all that same list, that identical list to the index. So that's what you're describing, right?
Yeah, that's exactly right. It's a reconstitution, and each may have a different period or approach, but you're right. Anyone that tracks that from a strategy, a mutual fund or ETF has to buy in that date. So then when you think about, let's say we just give an example with an inflow. You get $10 million of inflow. Mm-hmm. When you get $10 million of inflow, you're going to buy Apple, and I'm making this up. Let's just go with the standard. You're going to buy Apple roughly 5%, Microsoft 4.95, and you're going to keep going through the list proportionally to its exposure.
Yep.
Now, that's how you had to operate before, but think of a dimensional approach. Is that really the best way? Markets move each and every day. Prices change each and every day. We want to use that information to lean into those segments where we think we can have a higher expected return. Right. And so from a buying and selling, an index strategy would buy in proportion and sell in proportion. For us, that doesn't make sense. We want to buy the stocks that we think are more attractive and sell the ones that we think are less attractive. And so what that requires is flexibility and not having to buy proportionally or sell proportionally. And so that's what the ETF rule allowed. It allowed us to be able to build a basket, as you said, of those stocks that we, when we have an inflow of those stocks that we think are going to have a higher expected return, and sell the ones that we think have a lower expected return. And that's the idea behind it. You can let me know how that was in terms of level. If I got simplistic enough, feel free to summarize, but it's all about that flexibility, not having to be forced to allocate pro rata. You can buy what you want and sell what you want.
Mm-hmm. That seems like a really important rule change. And once again, I'm reassured, and you've strengthened even more my confidence in our commitment to dimensional, because it's one of the things that we value and appreciate about what we call our evidence-based approach to the way that dimensional manages portfolios, having that flexibility to be smart about how the portfolio is allocated, rather than being locked into simply following an index no matter what. We're more interested in the asset class. So we're more interested in, are you delivering the expected performance and characteristics of that asset class? And that's what we look to dimensional to do. And I'm glad that the regulators changed the rules in such a way that it made it comfortable. Now, so Dimensional launched the first ETF in November 2020, and now, correct me if I'm wrong, I think there are 13 in the lineup. We've been using them as much as we can right along. Ordinarily, we would wait. We want to see a company have a track record before we kind of get into adding something to our portfolio. But because you guys have been doing this for 40 years, it wasn't, you're maybe new to ETFs, but you gave us enough confidence to let us know that you have the competence to turn a mutual fund approach into an ETF approach. So we kind of got in right away. With the existing ETF, how's it gone for you guys? So it hasn't been very long. How's it going? Are you getting some flows? You got a couple $1 million under management now, or what?
Yeah, it's been a wild ride, I'd say, over the past 15 months. And you're right, we launched our first strategies at the tail end of 2020. Going into this year, we did, and I think it's quite innovative, but one of the largest mutual fund to ETF conversions in history. For those strategies that were tax managed, again, one of the benefits of ETF is that additional tax lever. We converted those to ETFs because we could better deliver on that investment objective. So you're right, dimensional, we're not going to sacrifice something if it means going to another vehicle. We want that dimensional look and feel through everything that we do. Fast forward to today, you hit the nail on the head. We have 13 strategies, 4 are fixed income, 9 are equities, and we're about $45 billion in assets. And again, wow. I think that's just a testament to clients like you and others that they believe in dimensional, they believe in the approach. I think some of the success speaks for itself in terms of performance and track record and pioneers in the space that we operate in. But we're knocking on the door of top 10 ETF providers in less than 15 months of launching, and are the largest non-index strategy or non-indexed provider. So we're really excited, and I think a lot of our clients like you are excited as well as to be part of this journey that we're on here.
It's pretty incredible. That's remarkable success to go from 0 to 45 billion and become top 10 and number 1 in the non-index space in that short period of time is pretty darn remarkable. And we're glad that we can include them in our portfolios. So how do you compare? There are others that have been in this longer. Maybe talk a little bit more about how dimensional might compare to, well, who are the other kind of the leaders in the ETF space now, and how does dimensional kind of compare to those other approaches? Maybe we've talked about it, but go ahead and jump in there.
Yeah, so when you look at the largest providers in the landscape, they're going to be predominantly have a lot of their assets in some of those passive approaches where they are tracking an index, going through those reconstitutions as we talked about. When I think about dimensional's approach, I really think we bring together the best of both worlds from a traditional passive standpoint and active. So what are the benefits? Why do some clients invest in those strategies? There are benefits to them. First and foremost is they're broadly diversified and provide you with exposure to that segment of the market, whether it's US equity, small cap value, whatever it may be, they're broadly diversified. The second is they're generally lower turnover. And so that can lead itself well to lower transaction costs and some tax efficiency. And I think many investors look at those strategies and think, wow, they're very tax efficient. And then lastly, lower costs. I think from an investment perspective, they're priced pretty competitively. And so when we think about dimensional, we take all those aspects into every single one of our strategies. So 1, we're broadly diversified. 2, we generally have lower turnover because one thing we can control in our portfolios is transaction costs. And we want to be thoughtful around how we're doing that and flexible around the way that we're transacting in the marketplace. And we want to be tax efficient. But we don't stop there like an index strategy. We aren't forced to buy or sell on the 3rd Friday or 4th Friday of every month, quarter, 6 months, or annual period. We can be flexible about how we go around that. And so when I think about how dimensional approaches it and adds value on top of that is we don't track an index. We pursue higher expected returns. So look to outperform. And we do so through a daily flexible process where our portfolio managers each and every day, and Michael, again, you hit the nail on the head in terms of we're looking to provide you with consistency and exposure to that asset class or segment of the marketplace by looking at it each and every day and making sure that you're not having that drift that you could have if you're rebalancing or reconstituting, less frequently. And then lastly, I still think, we tend to price our strategies very competitively. If you look across the board in general, they're all in the lowest 20% compared to their Morningstar categories from an ETF standpoint. So we want to be competitive, but be able to deliver those options. And something we continually evaluate is fees. We've reduced fees on a number of our strategies last year and, continue to evaluate those as well.
Yeah, pardon me. I think that's important. I heard from Gerard Riley yesterday that Dimensional's reduced fees by something like 30% over the last couple of years or something. Anyway, amazing. We've got a question that I'm going to throw at you, and I think we addressed it a little bit before, but maybe let's dig in and see if we can get a little bit clearer about answering this question. It says, how does an ETF avoid or defer those capital gains, and how is it different from a mutual fund? And first of all, before you answer the question, Anthony, I think there are two parts to this question. One is structurally, what is it about ETFs that may allow for more efficiency? But also talk about how Dimensional's approach, even in mutual funds, and again, one of the reasons that we like using Dimensional is tend to be very tax efficient in any case. So, but talk structurally about an ETF. What is it about an ETF that inherently maybe allows for a little bit more tax efficiency around those capital gains?
Yeah, so I'll hit on the first piece and then we'll come to the second one after that.
Sure.
When you think about, and I'm going to go back to a stock, when you think about buying an individual stock, let's say all of us and the rest of the population in the US continue to buy an individual security. Assume that's your overall population set. The price is just going to keep going up, right? It's one way buyers, the price will keep going up. How an ETF is different is it can change the supply in the market. If there's a lot of demand, so the price just doesn't go up and it stays kind of where expected, it can create new shares. Now, in a stock, a company can do that too. It just would dilute. In the case of ETF, it doesn't work that way. And so you can create more. On the opposite end, let's say we have a lot of sellers. It can remove shares from the market to offset some of that push against the demand to purchase the strategy. And so the way that happens is it's through something called an authorized participant. And the reason I'm saying this is if you look this up, you'll be able to look into more detail after if you're interested. But we work with many authorized participants that can create new shares in partnership with us or redeem. Where an ETF gets its efficiency is on redemption, so on sells. So let's go through a mutual fund example first. I buy $10 million of a mutual fund. Portfolio manager goes out, buys those securities. I sell 10 million of that mutual fund. Portfolio manager, maybe they have some cash on hand and or depending on the size, they may sell securities to deliver back. They could sell then, or maybe they're selling because they don't necessarily have the same view on a stock anymore. And so they'll sell those securities. If they incur a gain, they have to kick that out. In an ETF, the way that you can get those inflows is they are delivered to you through stocks. So the AP, the authorized participant, is actually buying and selling. So let's go through an example when you're selling. And I know I'm getting in the weeds here, but this is where I would say the level 3.0 in terms of ETF knowledge. But when you have, let's say, $10 million sale, how it works is Dimensional, as the ETF provider, will deliver $10 million of securities to the authorized participant who sells them. We aren't actually the ones selling those securities for that. So you need those outflows. Now you may say, okay, well, what's tax efficient about that? Well, one, when we're selling securities, we want to sell those ones that we, from an investment standpoint, want to sell because they have a lower expected return. And we'll marry that with those stocks that have the highest gains. We'll kick those out of the portfolio to defer them later to when you sell your ETF shares. And so that's where you get the benefit. So going back to what I was mentioning to Michael earlier, it's not that every ETF will never pay gains. You need those redemptions to be able, or people selling to be able to offset those. And so that's really where the tax efficiency comes from in an ETF. We can approach it the same way with our mutual fund of being able to sell securities that are unattractive, lower expected return. We do that same thing in ETF, but it's more common in an ETF vehicle to kick out and defer those securities with higher gains.
Yeah. So really more efficiency just simply within the structure versus the structure that a mutual fund allows in terms of buying and selling and realizing those capital gains within the basket. Yeah. Hope that makes sense to people.
Exactly. Should I get on the second component of that now?
Yeah,
on
go ahead.
Dimensional?
Yeah, please. Yes, of course.
Okay. So long-winded there, but that is definitely the nuts and bolts. If you want to find out more information, you can look up tax efficiency of ETFs, or creation and redemption mechanism is kind of the term in the industry. And it can go through some visuals and details. And we actually have some too on Dimensional's website. But that's that. The second component is, why do we tend to be tax efficient? And it's by design of our strategies. So one, we're broadly diversified. We have many securities in our portfolio that we can choose to buy and or sell. Two, we're low turnover. So when you think about low turnover, it's not just about transaction costs, but if you're turning over your portfolio less, you're selling within your investment strategy securities less from a gain standpoint. So when I look across and say, okay, what do we mean by taxes? There's income, so think dividends, and there's gains. So I sell a stock that is appreciated or a bond that is appreciated. From a income standpoint, that's somewhere where historically Dimensional has always won that space. And the way that we're able to do that is by having a daily flexible process. We aren't indexed. We don't have to wait for a certain day to buy or sell based off of what an index says. Let's say we get a stock that says, I'm going to pay a dividend. In order for that dividend to be qualified, lower tax rate, you have to hold it within a 61-day period. Well, we may say, oh, it's worth the wait of the extra 5 days for us to hold this and make sure that we get this as qualified. So we've historically been attractive from an income standpoint. On the gain component, those long-term capital gains, so again, selling a security that's appreciated, that's where ETFs have had that benefit. And so when you see some of those, the larger players, the largest players in the space that you alluded to, the reason that they tend to be tax efficient is because of that mechanism I just talked to you about. They have that additional tool and lever that they can use. Now, when you say, okay, well, let's look at a Dimensional's mutual fund, we tend to stack up well against them without even having that lever because we focus on income, because we have flexibility. And you can see that through some of the tax efficiency ratios that we look at. Now with ETFs, we have that additional lever as well to use as a tool for our strategies. And so I think Dimensional overall is extremely tax efficient just by the way that we design and think about markets and building our portfolios.
Yeah, I think that the simple fact that, again, comparing to an index, that you're not locked into reconstituting or simply trying to mirror that index blindly, but rather delivering the return and the characteristics of an asset class, you can hold something, for a while, as long as it's within the asset class and it hasn't drifted out of the asset class. If we're trying to hit small value and suddenly it's drifted into a mid cap or it's grown to a large cap, then obviously you're going to move it out. But otherwise, why sell it unless you have to? We've got another question here, which is good. Are there any further timing or otherwise tax benefits for an IRA with RMD requirements and the timings of executing an RMD using ETFs? That one we may want to take offline, but I'll punt it to you and see if you've got an answer to that with respect to ETFs. In other words, I think I'll try to interpret a little bit. Can ETFs be used within an IRA strategy, especially where the IRA is having to kick off income periodically to meet required minimum distribution requirements? Do the ETFs give us more flexibility or give us an advantage in managing a portfolio from that perspective? I'll let you see if you want to take that on.
Yeah, so I'll hit high level and then I'll defer to you on one-on-one, and happy to bring in
Sure.
someone else that may be more of an expert. But in general, when you look at retirement accounts, you don't often see with many providers where your retirement account is set up at or where you transact through ETFs on the platform. ETFs haven't historically been those options. And part of it is because exactly that they have this major tax additional lever that you can use. Well, you may not necessarily need that for that vehicle. Outside of that, it's the same. We can have the same approach in a mutual fund and an ETF. So you could have it and have those, the same investment philosophy behind it, but the lever isn't as beneficial in a retirement account. There are some companies out there that if you use through those retirement accounts that, Michael would partner with that do have some ETFs on their platform, but it's not that common yet. And so when you think about where the ETF industry is going, that's one of the questions coming up now is there are other benefits like no transaction fees and being able to trade throughout the day, that these benefits may make sense also in retirement accounts. It's just not popular to have them in retirement because the tax lever doesn't give you that benefit.
Yep. And I'll address that a little bit more. You're primarily replying based on 401k accounts rather than IRAs. From a tax efficiency standpoint, you're right, since we don't really care so much about capital gains within an IRA, the other benefits come into play. It's really the low turnover helps us keep costs down, and other things keep the expense ratios and the costs down within the portfolio. And trading, when we're rebalancing, the ETF isn't going to have the same transaction costs associated with it that sometimes we'll see in the mutual funds that we use. So that's where the efficiency really comes in on the IRAs, or where we're managing retirement portfolios for our clients outside of 401ks. So yes, the tax efficiency is a little bit different. It's really has to do with what I might call mechanical efficiency and cost savings overall. So yeah, a little bit different situation.
You're right. I went straight to 401k, and then you said that I was like, the question was IRA, so I apologize. You're correct. Still, you can take that tax benefit out, but you're right. Those other pieces do come into play and can be beneficial.
It's true. It's like using why don't we use municipal bonds in an IRA? It's because that tax-free income doesn't really gain us anything. Now, we may still want to use a municipal bond for the asset class performance. It may give us some benefit, but we're not getting any tax benefits. So typically, we're not going to use them in the IRA. So in a similar way, that's how we think about it. Let's move on a little bit. We're getting we got a few more minutes. So if people have other questions, I invite you to go ahead and enter them in either the chat or the Q&A. But I want to talk about the future and kind of where things are going. Thanks for giving us a rundown of why dimensional is in this space. And as I said, we certainly are enthusiastic about it. Where are things headed? So from dimensional's perspective, and I'm going to ask this in a couple of ways. One is industry-wise. From an industry perspective, I'd love to get your opinion about where you see the ETF space going, but also more specifically, where's dimensional headed within the ETF space? So take those in whatever order you'd like.
So maybe first on the industry standpoint, I think we've seen a ton of evolution over the past 10 years we alluded to in terms of asset growth, product growth, different types of solutions, which make your job, Michael, probably a little bit more difficult, having a bunch of different ones out there. But of course, you have partners like ourselves to be able to share some insights around different types of solutions, and as well as portfolio analytics and tools to leverage. But going forward, I think we're going to continue to see, even last year, we had more active strategies, and they can be systematic in nature, like a dimensional, but more active strategies launched than we saw passive. And so I think there's going to be continued focus from that standpoint. There's been news about maybe some other companies doing some conversions. And so I think we're in for an interesting next 5, 10, 15 years in the ETF industry. But my guess would be, where we back up 10, 15, 20 years and the industry is dominated by just traditional index tracking strategies, if we fast forward 20 years from now, I think it's going to look a little bit different. And it already is, and we're seeing some of that evolution. In terms of dimensional, you're right. We have 13 strategies today. When we launched our fixed income at the tail end of last year in November, we filed for an additional 10 strategies. So we heard a bunch of feedback from clients. They do want some of those more specific asset classes. So for example, like a small cap value space in the US and international. And so we're trying to be able to provide those type of solutions so that you and other clients can meet your clients' objectives as well. And so that's really where we're going. If we think a little bit broader and longer term, that's, those 10 strategies we look to launch in the first half of this year. Taking a step back, we want our ETF lineup to sit next to our mutual fund lineup, be broadly diversified, provide clients with choice across different vehicles to meet investor preferences and needs. And that goes for mutual funds, that goes for ETFs, and even our custom SMA platform that we updated, I would say, to lower the overall investment minimum significantly to provide some customization to clients that do have some of those views, if they want to exclude certain securities or environmental or social segments of the marketplace. And so having just a broadly diversified offerings across mutual funds, ETFs, separately managed accounts, and being able to access all of those even in a dimensional model. So I think that's really where dimensional's moving towards.
So what I'm hearing, if I could paraphrase a little bit, at least from what we might see coming from dimensional, and since you've said all along, dimensional's been trying to meet the needs of clients or advisors such as us that are using your solutions for our clients' portfolios, we'd like to be able to really fill any asset class with an exchange traded fund, with an ETF that would give us that cost efficiency, lower trading costs, and lower expense ratio. If we could fill every asset class with an ETF that way, we would love that. So I'm kind of picking up from you that that's the direction you guys are going to. If you can give us solutions that can kind of hit any asset class, then we can kind of fill portfolios that way. So I'm taking that to the bank. You might not have said that, but I'm taking it to the bank.
It's close enough. Close enough.
There you go. What else do you think? What haven't we talked about ETFs, about the ETF space or ETF strategies that you think our audience might want to hear about or should know about? Is there anything that we've missed?
I feel like we've hit on a lot. Maybe I think you alluded to it, the reconstitution, and even yesterday, our co-CEO and CIO talked about some of the reconstitutions. And when you think about when some of these index strategies go through a rebalance or reconstitution, you can look at what happens from the return. If you look 40 days prior to that, when it's supposed to reconstitute, and 40 days after that, and what does that look like over time? And there's been a lot of articles out there, like Financial Times came out with a big one recently around how this might have a lot of costs that are deducting from performance. And so again, I think it just goes back to the way that dimensional thinks about markets. First and foremost is flexibility when we go to transact in the market. And secondly, the way we build our strategies and manage them, having the flexibility, not be bound by an index, but doing what we think is in the best interest of our shareholders, which is lean into those segments with higher expected returns and having that flexibility to do that. I do think it's really important. There's been a lot of news around that lately, so I thought I would just mention that because a lot of large news publications are putting out some comments around that, and academia.
It is, and I think I think I'd like to see more. I don't think there's enough, because I read that article too. I saw it in the Financial Times, and what was it, $4 billion in cost to consumers from these inefficiencies simply from the indexes having to kind of go through this reconstitution, which is massive. I mean, especially since the industry has done such an effective job marketing the efficiency of indexing and the cost savings of indexing. There's some hidden pieces there that need to be uncovered, and consumers need to learn a little bit more about. I won't get on my soapbox, but I'm passionate about the topic.
And you're right, it was 4 billion, spot on.
Yeah, was it? I remembered correctly. Yeah. That's a lot of money. That's a lot of money for consumers that have sort of believed the hype in a way that indexing is the way to go. Not that there aren't some great things that have happened from indexing, but it can be improved upon, and that's certainly our approach is, being a little bit smarter, following the academic research and following the evidence. We can be a little bit smarter and reduce some of those inefficiencies and those costs. Well, Anthony, we're coming up to the end of our time. I'll put out to our audience. We got a couple more minutes. If anybody else has any questions, please raise them. But in the meantime, I guess we'll start to wrap up a little bit. I want to thank you. What's next for you? I guess, are you doing these kinds of presentations all across the country every day these days, or what's going on for you in the coming weeks, Anthony?
Yeah, we have a good amount of these coming up, some virtual, some in person. Obviously with COVID, really it depends on a lot of different factors. As you can see, I'm home today. Some of that flexibility is actually nice, especially if you have a little one at home. And so definitely doing a lot of these types of sessions and speaking about our ETF business, kind of where we're going with the business. And again, just hearing from you all and clients on, what you're looking for in dimensional, so we can continue to improve and be able to provide you with those types of solutions.
So obviously, we're not the only ones that are interested in hearing more about ETFs. Are you getting inquiries really from across the country? Is this a common theme that people are asking you to talk about?
Yes, since joining Dimensional, I would say I've had not too much sleep and working quite a lot, but I think that's just a testament to our clients' demand for ETFs and being able to bring a solution that I truly believe we are driving the ETF industry forward. And I think you see it with some of the press that's happening around it, being at $45 billion, the partnership we're building with our clients. And so it's really exciting. And so I'm not too worried about sleep when we get to engage with clients like yourself and everyone else on this call. We do appreciate it.
I like to hear that. So what I'm hearing is that Dimensional and us by default, we're not following, but really leading in the evolution of ETFs and how ETFs can be used efficiently and effectively to help clients, to enhance clients' experience and ultimately their investment experience. So thank you, Anthony, for joining us today. Really appreciate your time. Thank you, audience, for participating today. If you have further questions after this, please don't hesitate to reach out to us. We'd be happy to meet with you one-on-one or answer questions via email if you have following up. And certainly if you have friends or others that you feel like would like to learn more about ETFs or how we're using ETFs to help clients have a better investment experience, certainly don't hesitate to put them in touch with us too. We're happy to talk to them. So next month we'll be back up in February for another topic. So look for more information about that. And we will post, as usual, this recording on our website probably next week. Usually it takes about a week to get it up and posted. Anyway, thank you, Anthony. Thank you, audience. And we will sign off for today.